Once upon a time, money meant something real. Gold and silver weren't just shiny metals, they were trust in physical form. Every coin had intrinsic value. Kings and merchants used them because they couldn't be printed out of thin air. But that was the problem. You see, real money had limits. You couldn't create more wealth without mining more gold. And for the rising empires of the 18th and 19th centuries, that limit meant power itself had boundaries. Governments could not spend freely. Wars couldn't be funded easily. And banks couldn't create money out of promises. So, someone came up with a different idea. Visual. 17th to 18th century bankers, the Bank of England's founding, paper notes being exchanged. Narrator. It began in the late 1600s, when the Bank of England introduced something radical, paper money. Instead of paying with gold, people began using banknotes, paper promises that represented gold stored somewhere else. It was convenient, faster, modern, but it also opened a door that would change everything. Banks realized they could issue more paper notes than the gold they actually had, because not everyone would demand their gold at once. That tiny loophole, fractional reserve banking, became the root of the system we live under today. Money no longer needed to be backed by anything. It could simply be created. And with that power, banks became the new kings. 1913, images of U.S. Congress, President Woodrow Wilson, Federal Reserve Act. Narrator. The real transformation came in 1913 with the birth of the Federal Reserve, the central bank of the United States. This wasn't just another bank. It was a money factory. For the first time, money supply and interest rates could be controlled, not by gold, not by the people, but by a small circle of policymakers and private bankers. And here's the twist. Every dollar issued by the Federal Reserve was created as debt. When the U.S. government needed money, it didn't print it, it borrowed it in exchange for interest. Meaning, from that moment forward, every dollar in existence came with a price tag, debt plus interest. Pause for effect. If all money is created as debt, then who can ever repay it? You can't. Because repaying it destroys the money supply. It's a trap by design. Visual. 1944 Bretton Woods Conference, 1971 Nixon speech. Narrator. After World War II, the world agreed on the Bretton Woods system, a global financial deal that tied most currencies to the US dollar and the dollar to gold. For a while, it seemed stable. The dollar was as good as gold. But by the 1960s, something broke. The US had spent massively on wars, welfare, and expansion, printing far more dollars than it had gold to back them. Other nations noticed and began demanding their gold back. Then, on August 15, 1971, President Richard Nixon made an announcement that changed money forever. He, temporarily, ended the dollar's link to gold. But that temporary move never reversed. From that day on, money became purely fiat, a Latin word meaning by decree. In other words, money had value only because the government said so.
No gold.
No silver. Just trust and endless debt. Credit cards, mortgages, stock market booms, 2008 crash. Narrator. Once money was unchained from gold, governments and banks discovered their new superpower. They could create infinite money and drown the world in debt. Every dollar you borrow from a bank doesn't come from someone else's savings. It's created when you sign the loan. That's right. When you take out a mortgage or swipe your credit card, new money enters the economy. Money that didn't exist before. But when you repay it, that money vanishes. The only thing that remains? The interest. And since interest isn't created alongside the principal, there's always more debt than money to repay it. The result? A system that must grow endlessly to survive. If people stop borrowing, the economy crashes. If governments stop borrowing, the system collapses. And when debt rises too high, they simply print more money. It's a treadmill you can't get off. Visual. Billionaires, hedge funds, luxury yachts versus struggling families, student loans. Narrator. So, where does all that created money go? Mostly to the top. Because new money enters the economy through banks, corporations, and governments, not through ordinary people. When the Federal Reserve prints trillions, it first flows to financial institutions, which then lend or invest it. That drives up the price of stocks, real estate, and assets owned by the rich. Meanwhile, the middle class sees rising prices, but stagnant wages. So what do? They borrow just to survive. Mortgages, student loans, car loans, credit cards. Debt becomes not a tool, but a lifeline. And every time you borrow, you feed the same machine that keeps you running in circles. Because in this system, money is debt. And debt is power. 2008 crash, 2020 pandemic stimulus checks. Narrator. In 2008, the system nearly imploded. Banks had created mountains of toxic debt, and when it collapsed, governments rushed to save the economy by doing what they always do: printing even more. Trillions were created out of thin air. They called it quantitative easing. But what it really was quantitative debt, an injection that postponed the inevitable crash. Then came 2020. Another crisis. Another wave of printing. Today, global debt has crossed $320 trillion, more than 3 times the world's total GDP. Think about that. Even if everyone on Earth worked for free, it still wouldn't be enough to pay it all back. Because the debt isn't meant to be repaid. It's meant to keep you dependent. Visual. Digital currencies, crypto coins, government CBDC mock-ups. Narrator. Now, the system is evolving again. Governments are preparing a new chapter: central bank digital currencies, CBDCs. They promise efficiency, transparency, and innovation. But behind the buzzwords hides the same architecture, a centralized system of control. Imagine money that can expire, be frozen, or tracked at the push of a button. A system where your spending habits, your savings, and even your behavior can determine your access to money itself. Sound extreme? It's already being tested. The same institutions that designed debt-based money are now designing digital debt-based control. So, what can we learn from this? First, modern money isn't neutral, it's engineered. Every dollar, pound, or rupee is born as debt, and that debt guarantees a constant demand for more borrowing. Second, inflation isn't an accident, it's policy. When governments print more money, prices rise, quietly eroding your savings, your wages, and your time. Third, real wealth isn't measured in money, it's measured in freedom. The less you owe, the more control you have. The more you depend on borrowed money, the deeper you sink into the system's design. Clock ticking, money burning, faces fading into digital code. Narrator, somber tone. We are living in the final stage of this experiment, where money has become numbers on a screen, and debt has become the air we breathe. The question isn't whether the system will break, it's when, and who will rebuild it afterward. History shows that every empire built on debt eventually collapses under its own weight. But before that collapse comes the illusion of prosperity, the calm before the storm. And right now, we're still inside that illusion. OUTRO. Open thought and call to action. Narrator. So the next time you hold a bill or open your banking app, remember, it's not just money. It's a promise and a prison. But awareness is the first escape. Learn how money truly works. Question the systems you've been told to trust. And don't just earn, understand. Because the more you know, the less they control. Visual. Fades to black with the words. Debt is the invisible chain. Knowledge is the key. Narrator, final line. If you found this story eye-opening, share it, because the system stays powerful only as long as it stays hidden. On-screen text. Subscribe for more deep dives into the truths they don't teach you about money, power, and history. Fade out, ambient music ends.